Hey everyone. I see a lot of you tuned in for Risk panel. Yeah, I guess let me start with a quick introduction. So we're at the moment in DeFi where the DeFi yields are competing with TradFi yields. There is more and more RWA assets being available on chain. More and more institutions entering with their own products. And I guess the choice has never been, like the users never had more choices in DeFi and they can basically pick whatever they want from. But at the same time, there have never been so much complexity in terms of what to do with your money. And as institutions are entering, we're still seeing multiple DPEGs weekly of plenty of delta-neutral stablecoins and protocols getting hacked and a couple of other unfortunate things. So the question for today's panel is the yield safe? And I guess we can start off with introductions of our speakers. Guys, if you could tell us a couple of sentences about yourself, about your company, and what you do. And we can start with you, Andrew.
Sure. Thank you. Hey, everyone. My name is Andrew. I'm one of the co-founders of Herd. Got into the DeFi space back in 2020 because of composability. Contracts have gotten a lot more complex since 2020. I spent 3 years at Dune analyzing protocols across Ethereum, Solana, and Bitcoin, and studying how every protocol was becoming more composable, getting you more yield, but also getting more complex. Finally started Herd a little over a year ago because I thought that a lot of the work that we do when researching and due diligencing and building on top of contracts should be done with the help of agents safely. So that's what Herd does.
Hey everyone, my name is Nikola. Some of you may know me as the DeFi Nikola on socials. I am a risk manager at BlockAnalitica. We're a team behind Sky Protocol, risk team behind Sky Protocol, formerly known as Maker. And we also do risk management for protocols like Hyperland, Summerfi. We have worked with Athena, but on a risk committee there as well. So yeah, that will be a short story.
Hey everybody, my name is Chris Walker, founder, CEO of Coop. For those of you who didn't see my solo talk, we finance payment companies, and for lenders, we allow them to allocate to those opportunities and earn a nice yield. My background's in securitized products, investment banking, and I've been in crypto since 2020.
Hello, everyone. My name is Phil. I'm a security researcher at Certora. At Certora, my work is a little bit different from the rest of the guys here. I spend all of my time looking at smart contracts to see whether or not they're safe. And this is the main thing that we do at Certora.
Thank you so much, guys. As for me, I'm Filip from RedStone. We do oracles, but we also have Certora product under the hood, which is the risk rating protocol. Well, I guess let's kick things off with the first theme. How yield is being generated and what risks it introduces. And you guys work with risk on a daily basis. So I have a first question to you. Walk us through the main yield sources or yield-bearing assets you work with. And what risks do you see they actually carry from that might be invisible from the headline number? Anyone wants to start or?
I guess I can name a few to start with. So what we're today mostly working with when it comes to different yield sources. So let's first start on chain. Let's say those are first the basic ones, LPing to both DEXs and perp DEXs, then some native lending, all the way to tokenized, more complex tokenized strategies, whether those are delta neutral, market neutral. And then we also cover, of course, now the increasing number of off-chain yields due to, to disrupt a little bit the cyclical nature of the on-chain yields. They're kind of more dependent on the crypto market itself, and those being tokenized private credit, even tokenized delta neutral strategies that are being managed like completely off-chain. Of course, wrapped T-bills. So yeah, this is just to name a few. I would let others if they have.
Sure, yeah. For Credit Coop, our yield is generated from namely two sources. The first source, and 90% of our yield is generated from the repayments that borrowers make, or rather the repayments that we automate on their behalf. And then the second source would be, we take that interest and then we compound it and we'll allocate to select morpho markets. So for example, maybe Gauntlet USDC Prime, or some of the lower risk ones that will compound the interest and still allow the principal to be paid by the borrower. I would say from a risk standpoint, what is not obvious to depositors, or what you can't necessarily see as easily on chain, is some of the behind the scenes risks. So concentration risk of those payments. And well, what happens if you have 80% of your volume from one borrower or one client, and then they have something that happens? So I think that's probably one of the bigger ones. And then I would say another one would be redemption risk, and really thinking through the duration of your deposit, and should you want to redeem, is there actually liquidity to meet that redemption? And the third one I would say that I think everybody probably agrees is Oracle risk. The hot topic is resolve, and maybe we'll get into that on the panel, but I think historically in DeFi, this has been a known attack vector, and sadly we still have instance like the resolve instance. So that's really important, is to think through what the source of the data is and what the Oracle is actually pushing on chain.
Yeah, for us, we don't directly invest in any of these products, but most of our biggest users are curators like Stakehouse and Gauntlet. So the asset class we focused on historically has been like stable coins. And the risk that we look at is a lot more on the operational risk side, right? Because for any stable coin, there can be up to 15, 20, or 30 contracts involved in terms of like, yes, there's basic minting or basic oracles, but there's going to be some master minter, some controller. It's pretty complex to untangle that across, like if you take some token like SNUSD, like how does that perform? How does that perform in the market? How is it operated? And then how is it tied to the underlying collateral? Now that we have like async deposit and redeem patterns in place like Centrifuge as well, there's just many layers of like trying to understand how does this token actually work, and like how does that reflect the actual underlying collateral? Because you could say like, oh yeah, it's a UST bill or something that's collateralizing it, but by the time it gets into a morpho market, it can have very different kind of operational or liquidity or redemption in and out queue levers that fundamentally change its like how we would think about its risk profile, right?
Right. My perspective on yield is more from an infrastructure point of view. So in my view, there is one layer which is where's the yield generated. So we have staking, restaking, LPing, lending. And then, as Andrew mentioned in his intro, this got really complex. So it's not trivial at all to manage LP. So we got another layer, which is the protocols and players who manage these things to generate yield and manage the risk of how to generate that yield. And as you add each specific layer, each specific thing that you do carries its own risk. And when you compose these things together, you add the additional yield. So if one protocol is exploited, often that's not the only victims, because if anyone has any exposure to that, they will be a victim of that too, if they expect for their token to carry any value.
I think we've seen it with was it DE USD, DPEG, right? Where we had whole morpho vaults liquidity crunched.
Yeah.
I remember our devs didn't sleep a long time at that time. But yeah, I guess that That could be at the same time the next question. So where do you see the biggest gap between how the risk is being perceived or like presented by asset issuers or protocols whatsoever, and between what is the actual risk that the asset comes with itself?
I would just jump in on that. I think one of the bigger things that stands out to me is a lack of standardization in how yields are presented, right? So if you want to LP into a protocol, like to your point about risk, typically in traditional finance, you get higher risk, higher reward. And that sounds like simple, but on chain, it's a little more complicated. Some front-end UIs will show a forward-looking, yield projection. Some will show a trailing 7-day average of realized yield. Some will do 30 days. So it's a little trickier on chain to know if you're comparing an apple to an apple or an apple to an orange. And I think that's what makes it a little challenging. And I think to Andrew's point, like, it is complicated. You do need to dig deeper and have a sense of what they're actually showing. And then to my earlier point, on the underlying liquidity in those markets and thinking through redemption. So I think they kind of are one and the same, right? If we can standardize how yield is shown on chain, we can then have a better sense of the risks, right, that are being taken.
Yeah, I would absolutely agree on the presentation of and the disclosures of the risk. I think by default there is definitely a lack of the metrics that like the average LP is exposed to. So I think there is a concentration on a single metric, which is an APY, and this is common to, regardless of the underlying yield source. This is probably something that most of the users are relying to. And as you said, I think things like, for example, the max drawdowns, the average time between some significant drawdown till the break even, or things like that should be there by default. Not just the price you get for underwriting that specific yield source, but rather who's your counterparty. I think this can definitely be presented in a better way, and I think we should enforce that somehow to make it as a default.
And just quickly, just to double click on that, like, I think a tangible example for the audience is, I won't name the protocol, but I know there was an optimizer, and for example, to the point about APY and liquidity, it saw this, from its API return some value as the yield source, and it was, marginally higher than their current position. They swapped into this position like $3.5 million, but then there was no liquidity. So when their little AI agent saw a higher yield, 2 basis points higher in another protocol, it went to swap and rebalance, but then it actually ended up losing 90% of its value because it didn't have liquidity to actually meet its trade and its logic. So I think like that to me is where things can go really poorly on chain, is not thinking through why the yield is what it is, and is there even liquidity? Sorry, Andrew.
No, you're good. Yeah, I think over time, like in the past, a lot of our research analysis, even like two and a half years ago, was more focused at the protocol level, because like, the tokens are more or less the same in terms of there's not really an intrinsic value. It's some crypto token that's been approved by Aave or someone else to be in a pool. And so like the complexity and the risk was really at the protocol level, and like as Phil mentioned, of like, oh, how does a pool in Aave maybe affect a market in Morpho? But over time, we found more and more of our customers and even ourselves diving just deeper into like the token fundamentals of literally like, how does minting work? If there's collateral, how does deposit and redemption work? And then what are all the oracles in the consideration, and like the time lags of these oracles? Because for the same U.S. Treasury, like T-bills, I know a bunch of protocols like have very different ways of updating the NAV on chain, and like what that time lag represents, how that actually reflects like the duration that might be underneath in those assets. So there's a lot more focus now for us there in terms of like just peeling those onions. It kind of looks like this is an engineering view, but it's like, it looks like a folder on a computer, and there's just more and more folders as you go down, and we're actually building a product that literally takes a token, makes it look like a folder, so you can kind of click through and be like, oh, okay, this part's capped, this part's not capped, this part of the yield, like the oracle kind of, it comes from there, versus this yield's actually on chain. And so we're actually focused less on like, oh, what is the MorphoVault v2 adapter risk, and more just on like, okay, can we just understand like all these different tokens that everyone says like, oh, these are RWAs or these are stable coins, and make it sound like they're very homogenous, when in reality they're like not homogenous at all, and that's like a very dangerous generalization, which is classic to crypto Twitter of like, oh yeah, or you can just wrap all RWAs, and when everyone says RWAs, it's such a loaded word. I'm like, oh, okay, this doesn't feel right. So,
I think we are. I love the coverage that we have here. What I would add is there are levels to it. So we have very sophisticated people here that go deep and actually understand on a very deep level how these things work, but. If my grandma wants to invest in crypto, and first thing she would do probably would be to open an account on an exchange, and then she buys, I don't know, Bitcoin, and then the exchange will tell her, hey, if you pair Bitcoin with this random unknown token, you can get 40% APY. And for me, this is the most misleading part of how it is presented from the not very technical user standpoint. This is super dangerous to me, because the person might get possibly 40% APY, but then lose 90%, because to get that, she would have to get this other token. And if there is 40% APY, there's a lot of volatility, so there's a higher likelihood that someone that doesn't really know the details of the specifics of how that thing works, they might end up losing most of their money instead of getting any APY, any yield.
You know what's worse than that? If someone deposits into like 5% or 6% stablecoin and still loses all their money. That's what I hate. So that's why I just like, yeah, whenever anyone asks me about the stablecoin, I'm trying to say, be careful, or like, make sure it actually makes sense compared to like treasury yields or anything else out there. But yeah, I guess as you guys see protocols expand to the new kind of assets that are out there, like RWAs, new yield-bearing tokens, I guess we already kind of touched upon this, but what is like your checklist? So what does the asset need to, like what kind of requirements it needs to fulfill in order, in your opinion, to be added to like the protocols and other parts of DeFi? And also, do you see any kind of yield that is, in your opinion, maybe being added too fast and like being perceived as too safe already, while it maybe shouldn't be so broadly used as of now?
Yeah, let me jump into the last question. I think it's now even maybe a popular opinion that the upcoming and the yield source that we are probably gonna see a lot more with as tokenized and in DeFi is probably a tokenized private credit. And just wanted to mention dumpy exit liquidity to tokenization of the private credit. As we're seeing like the global trend of the unwinding in private credit. So whether that's consequent or not, at the same time we're seeing like a huge trend in tokenization. So it is coming to DeFi, but I think we should be very careful when underwriting this, since it's not trivial to price it accordingly and to evaluate like the operational and counterparty risk when it comes to it. So yeah, I would say this would be the sector that it's probably going to become big when it comes like to the amount of loans we're gonna see even on chain. But yet again, not like the most secure one, at least not according to like current global trends.
Go for it.
So I was just gonna just double click on like the private credit, and I think it's a really fascinating topic to talk about, and 100% agree with what you said, Nikola, about, I think in private credit, there's kind of two buckets. There's what's happened, call it since COVID to now, with a lot of private equity sponsored deals where there's a private credit fund and he is going to lend direct to this company, direct lending, right, within private credit, to a private equity sponsored company. And that right now is where you're seeing a lot of hits and a lot of funds doing very poorly. Blue Owl being probably one of the worst with some of their deals. I just wanted to shine light on like part of the earlier question that Filip made, which was like, well, you know, how do you actually verify yield? How do you look at adding new assets to your protocol? And I'll speak about our protocol specifically. Within private credit, there's also another subsegment called private asset-backed finance. And private asset-backed finance is growing rapidly, while direct lending is starting to have some really big strains and some redemption halts. And asset-backed finance is growing because as the lender, you can have granular controls and really know exactly what you're exposed to and who is going to pay you from that exposure. So I think as we at our company think about expanding into different markets, one of the big things we look at is, well, does this fit into that asset-backed finance role? And what I mean is, are we aggregating, you know, thousands of individual cash flows and collapsing that into one payment? Or is this, kind of to my earlier point, is this concentrated as a direct loan to one data center and has projections about what the cash flow will be, but the reality is those projections won't be met because they aren't even done with the construction yet. So I think there's a lot of things that you need to look at when you think about private credit, and liquidity and projections versus realized is very important in this space.
Yeah, I mean, also on the private credit line, like my previous life before crypto was in investment banking, and it's like we've brought credit kind of on-chain, but all the tools of like protecting yourself from like ultimately when defaults happen, none of that is really on-chain, right? Like all we have is NAV, right? All the tools that like investment banks typically have around like, you know, the restructuring team or like credit default swaps, and all the tools there. Like, you know, no one's itching to bring those on yet, right? But if you don't have the like, or like just more transparent covenants, and like without, like if NAV is the only thing being reported on chain, and then it's like, oh yeah, in liquidation, like, yeah, just push it to some other holding company that's probably also managed by the private equity company, because like, I doubt there's clear separation of concerns there. And like, then the users on chain, it's like, okay, cool, your USDC is just gonna be locked there for 12 months. And like, hope you forget about it, right? And you have no way of really like, there's no force deallocate button on chain right now, right? So I very much, I like to ask like, you know, asset-backed securitization, and I think like some of the stuff Centrifuge is doing, I'm like, okay, when I'm looking through the contracts and like the redemption cycles and everything, I'm like, okay, this makes sense. But like specifically like direct lines of credit, whenever I see that, I do get kind of concerned, even if it's like corporate loans or corporate lent bonds. I'm like, okay, this is kind of worrisome. So
yeah, my perspective on this is what concerns me the most is lack of transparency, because if you know what you're buying and if you know what's the product and these specific details that matter a lot about what's the expected value of the investment or of the asset that you're buying, then you have to make a decision about if the risk return is appropriate. But what concerns me is lack of transparency. If there's anything that I do not know exactly how it works, if it's shady, if it doesn't share the details, then that concerns me. Otherwise, it's like, even if it looks shady, but if it presents you an opportunity for an outsized return, like, yeah, you can lose 100% of your money, but if it goes right, you can make an outsized return. Then that might make sense for some people. But if you do not know how that works, then for me, it's I would say it's uninvestable.
guess we got private credit on chain around the same time we got the biggest private credit crisis potential in a decade. So lucky us in crypto. Okay, guys, how you differentiate types of yield-bearing assets that have like structurally sound yield sources from the ones that are just like incentivized? And from your experience, how do those differentiate when something hits the fan, right?
I mean, so I'll say sustainable yield. If you have a borrower that pays a lender because they need access to capital, that feels organic and sustainable when I look at protocols or look at different borrow-lend platforms. When 50% or more, or even anywhere 10% of that yield, whatever it is, whatever the number is incentivized, right? I think at least I'll speak individually. Like I always just sell the rewards as soon as I get them, right? It's just, to me, it's incremental. So I think that the truth is, like, if you have to incentivize people to use your product, then I don't view that as sustainable. There's some caveats and some nuance to that statement, right? Like in traditional finance, some private credit funds will demand like preferred equity or warrants, right, to gain ownership in like the company that they're lending to. And on chain, sometimes you see that, right, in token emissions. But just from experience, at least historically on chain to date, usually those are down only and don't really add much real yield unless you immediately dump them on the market at spot. But I don't know if anybody's different thoughts. I think it's a challenge, right, to have a sustainable yield if you have to incentivize it.
No, yeah, I agree. I think it's a pretty straightforward answer. I think incentives could be like a booster of initial adoption, but yeah, in the long run, it doesn't work basically. But yeah, just if I may, to continue a little bit on the topic of the transparency, I just wanted to add, so the audience is aware, I think like the users generally in DeFi, so it's a little bit going back to the topic. Users are, it's safe to say that users in DeFi used to easily verifiable yield sources because, coming from the, like over collateralized lending and the Excel ping, we didn't even need to ask a question of is this really backed or is this really delta neutral or market neutral as a yield source? And I think it's not going to be trivial to replicate that same setup with like the increasing number of tokens that are kind of powered by the off-chain yield sources. But there are definitely some, let's call them best practices and something that we can do. So I'll just name a few. So let's say the first one is frequent attestations by independent third-party attesters. But then better yet, if you are able to offer to your potential suppliers and investors a way to prove at any point via ZK proofs or similar that you were actually having like a full reserve and you're actually backed or whatever the investors require, they're actually running delta neutral and running market neutral, or being something that they are kind of assuming. I think that will be good enough approach, at least for the time being, and it is comparable to something we are definitely used to in DeFi, which is, like complete disclosures. So yeah, sorry for getting back onto transparency.
Oh, good.
Right. For me, incentives are like ad spend. So it's like spending on ads. You wouldn't. I see it as a marketing effort. So if the success of the product relies on that, then for me it doesn't work. Because once it runs out, and we see it every time, almost every time, that there are incentives, there's TVL. The incentives are gone, the TVL is gone. I don't know, if you launch a new protocol and with incentives, And then after the incentives end, you lose 70% of your TVL because users withdraw because of lack of incentives. That might be a good strategy still, because it allows you to launch your product, and now everyone at least knows its name. Some people have deployed capital to it, so it's an ad spend. It has its use, but not for if it's required forever. I don't see it as something sustainable.
I would say on the other side, like if you can structure the incentives in a good way, it's very hard to do so. Yeah, you can achieve incredible things with that. Like, I'm not sure if on stable coins we got a good example, but Ethena is partially that, right? Because they grew to like crazy level. Everyone knows them, and it's been all like at the beginning it was all incentives, right? Or like on perp dexes, it's very visible there. Like if you attract enough liquidity with incentives and it stays with you, then you can get a lot of success.
Yeah, and sometimes you can decrease the spend of the incentives. It becomes cheaper as once you reach enough volume, enough organic volume, to get incremental volume and to get incremental people to know, you don't need as much money as you need to get the thing started.
Exactly. The issue is there are like 9 out of 10 incentive programs that just like right when the incentives ends, the protocol just like dries out of all liquidity, and like 1 out of 10 or like maybe 1 out of 50 actually works out and becomes like a leader or something.
I think you made like a really interesting point, Philip, about Athena, and like there are really good examples of incentives working out well, and I think really to judge that, it takes, you need to like talk to people and participants in that market and get a sense of, well, you know, for Athena, for example, well, people wanted to own that, right? They wanted to own more of the network, and I think in those scenarios, right, it's a no-brainer, and it's, you mentioned like limiting emissions and changing the emission schedule, and I think a great project that did that would be Maple Finance. You know, they now have some rewards and they cut them down, and the people that get those rewards, they want to own them, right? They want to own more of the network. So if that's like the lens that participants are taking, it's a really, I mean, it's the most powerful tool, right, to scale your network, as Athena, you know, represents. But if it's kind of what I stated earlier and it's really more marginal, like it's just viewed as, hey, we're increasing our yield, our effective yield, then they're just going to dump the token, right? And if you can look into the data and see, well, okay, how much of our emissions are actually retained and held for, you know, longer than, call it a month, or maybe ideally, right, 6 months, 1 year, it's probably a really, really effective liquidity bootstrapping method.
Actually, about Ethena, I had one more spicy questions in there for you guys. So Ethena right now is, I checked the numbers before the panel, and the USDE yield is at 3.5% right now. You can get the treasury yield at like around 4% at this point. And my question to you is, are delta neutral stablecoins just like pure bull market product? Like, do you see any reason why people would just like keep holding those in the bear markets?
The treasury bills are not available for everyone. Actually, most of the people in the world cannot. It's very difficult in many regions to hold USD or anything that's denominated in USD. So there is this use. It doesn't, from a, if the market was more efficient, more open, more accessible, it wouldn't make sense at all, because you are running a lot of risks by holding any token at all, any software risk, several types of risks. But if your option is to not have any exposure to an asset that is important for your financial protection, then it might be worth it. That said, it's a big roadblock for me that stablecoin issuers, real-world asset-backed stablecoin issuers, they cannot share yield So this, for me, is one of the main, the main source of this discussion that we're having right now.
And I think it's a really interesting point because Athena, I mean, Philip, you kind of described them as a stablecoin. I would never call Athena a stablecoin. I would say, synthetic dollar, like to your points, you make really valid points about access to T-bill yield. It reminds me of traditional finance where you had like euro dollars offshore, but I guess in this case, the backing is more akin to like a hedge fund, right? That swings bullish or bearish depending on where we're at in the market. And if you look at Athena's underlying reserves, I mean, they're now changing, right? I haven't looked recently, but I imagine, given where their yield, you said to under T-bills, majority of their reserves are probably in T-bills at this point. So, it's not the same product it launched as, and I think they did that to make their product better and make it more stable. But I still don't really view it, I think synthetic dollar is maybe a better phrase, but the way I mentally modeled it is similar to like a tokenized hedge fund, right? Where in a bullish price action, they can allocate those reserves into the basis trade, whether that's Bitcoin, Ethereum, and generate outsized returns, and then allocate that into higher quality, lower risk products whenever the basis trade goes negative. So it's an interesting play between the T-bills and like the hedge funds because most people in the world can't access a hedge fund either. So it's a definitely interesting product, but it has some risk.
Got it. And like the last question to you guys, it's a bit more personal. Let's say I give you $1 million each for participation in this panel. And there is one twist to it. You have to keep this 1 million in like stablecoin yield sources or like any on-chain yield sources for a year before you cash it out. Where would you put your money into?
Can we diversify or needs to go only
You
one?
can do whatever.
Okay, I'll go first. I'm biased, but I put 70% in my company, Coop. After fees, we'll make 11 to 12%. And the remaining 30% I would split between sniping Pendle PT markets that just launched and LPing on Uniswap in a very concentrated range between USDC and USDT. Yeah.
Is there alpha in sniping? Early PT?
There's a lot of alpha in sniping early PTs.
Good
Athena and EtherFi, I mean, back in the day, you can make 50% on your ETH if you snipe the right EtherFi markets on Pendle.
You see, some alpha. Phil, you wanna go on?
Oh, I'm conflicted for this one. Sorry.
Okay, no worries.
I mean, I think for me, the hard part here is like, oh, if this is like a herd coin or something, and I'm not allowed to, it's like, oh, I have 1 million of it, quote unquote, but like, how am I swapping that into other markets? Like, I have to, if I want to borrow against it, if I want to sell against it, like that liquidity has to come from somewhere, right? And I feel like this is, probably not in the heart of your question, but I think this is something a lot of stablecoin issuers like run into of like, okay, you have the reserves, you have the token. Ultimately, you end up having to work with USDC anyways on chain and the USDC yield sources. So it's like, ultimately somehow find a way to swap into USDC and then do whatever the popular yield strategy is of the day. But going between the stable coins when you maybe don't have enough liquidity or don't have all the markets set up yet.
You mean there would be no enough liquidity for like $1 million, or what's the?
Who knows? Yeah, I mean, if it's our own stable coin, but if we assume there's more than enough, then it becomes okay. How do I leverage up on our own token? I guess so.
Got it.
Brings its own risks.
For sure.
Yeah, I'm going to be probably old-fashioned. I'm going to say SUSDS, and that's it. No, I think it's a amount that is significant enough to, don't go way too much down the risk curve. So I think SUSDS is actually diversified enough by itself by the design now with the prime agents, aka the stars of the Sky protocol that are kind of essentially acting as a capital allocators. So there is a lot of different and various yield sources already that is powering like SUSDS. So that will be a simple answer for me.
Reasonable. Yeah, I like it. All right.
Well, it's bear market, so I won't give you $1 million. But I have some RedStone socks for you guys.
Nice, thanks.
Thank you very much.
Thanks so much.
Yay.